Okay, before we jump in, I'm going to be back in Costa Rica end of November. So I have 2 weeks open, November 16th to the 22nd and November 23rd to the 29th. I can accept three seminar participants each week if you're interested. Send me an email. It is meldrum period B period M at gmail.com. And it is a week of markets. Markets close at, actually, they'll close at 3 instead of 2 because we fall back an hour. Costa Rica doesn't move, it doesn't change its clocks. Yeah, so instead of the markets opening at 7:30, they'll be opening at 8:30. By 3 in the afternoon, you'll be done. So we have lots of things that you can do during the week as well. We do have horses. As you can see at the bottom, we have 4 beautiful horses. We have a big corral in here as well. So if you want to learn how to ride horses, we do have somebody on site who is an expert horse rider. They could show you how to ride horses. We do have an ATV if you want to take it through the, not just on our property, but I have like 6-7 acres on the side of a mountain. But you can take it through the condominium area. These are just winding roads that go through the mountains, so you can take the ATV out for a ride if you want. We have a great view at the top of the mountain. The sunsets are just absolutely spectacular. And we have a 57-foot pool outside, really nice. And it is going into the summer season. This wing of the house that you see back there, those are all the bedrooms back there. So your sliding glass doors walk right onto the pool area. Unless you're upstairs and you walk into a balcony with an incredible view. But it is a great vacation for a week, and during the day you will learn some things about markets. So if you're interested in joining me in Costa Rica, I can accept 6 people because I got things I got to get done there, so I can't have a full crew, 5 to 6 like I normally do. But 3 is just about the right number. I know it's short notice. November 16th to the 22nd, November 23rd to the 29th. I can only wait till maybe about Wednesday or Thursday for confirmation, and if I don't have the numbers, then I'm just gonna cancel them. So let me know. All right, let's head in. This week we'll lead off with just rates and yields. We'll look at CPI on the next page. The only government data piece we've had in a while. I don't know how valid it is. It had, I think, the largest number of imputed prices, not observed and calculated, but unobserved and just imputed. With the release of that CPI report, money market rates came down, pricing in a rate cut next week. Equities went straight up, pricing in a rate cut next week and more to come. And ZQ went up and then said, no, we are not going to price in rate cuts. In fact, let's start pricing them out, and started coming back down. Very odd. Another odd thing, the 10-year. Have a look at that. We're at 4.02 on the 10-year. France is at 3.46. France has a lot of debt issues. Moody's just downgraded their debt again. They have governing issues as well. And their 10-year increased like 40 basis points over the course of the year to sit at 3.46. 3.46. So investors expect a lower yield from French 10-year bonds than they do from U.S. 10-year bonds. Just let that sink in for a bit. They're willing to buy French 10-year bonds at a yield that is 56 basis points lower than U.S. 10-year bonds. The U.S. is seen as riskier than French bonds. Also, the French market, the French stock market's up 26% this year. The U.S., 15%. That French equities have been seen as a better return than the U.S. clearly macro is just not working anymore. We have a FOMC on Wednesday where we do expect another rate cut. Not to be outdone, the Bank of Canada will show up first with their rate cut, 9:45 a.m. Also on Wednesday, given the strains that we've been seeing in the repo market, it would not be unrealistic to see the end of balance sheet runoff. Right now it's $5 billion in treasuries. That's nothing. May as well end that, really. $35 billion in mortgage-backed securities. But only about $15 billion runs off each month because prepayments are so low. If you end that, you then end up with about $20 billion of purchasing power for treasuries. So the balance sheet is going to be, I think, a thing of focus. Look at the probabilities. We did have last week probabilities between 25 and 50. It's now back to 0 and 25. 3.3% are betting on nothing. Who are these people and what are they looking at to get nothing? This is what I said earlier, that the ZQ just started saying no, 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 and equity started saying yes, yes, yes. Money market rates started saying yes. Long end of the curve started saying no. What's going on here? 3.3%. A bet of 3.3% on nothing happening. 96.7 on 25. We have a shutdown in progress. Job market does not appear to be getting any better. And this past week, boy, did we get some layoff announcements from a bunch of companies. And Amazon, probably with the boldest one, 500,000 to 600,000 jobs. Not reduction, they're saying, to be avoided over the next few years due to robotics and AI. And I think that's exactly what's going to happen, is AI has eliminated the need for me to continue looking for people to do work altogether. I cannot be unique. I cannot be the only one that's figured that out. So I think that's going to be a problem, a bigger problem going forward. I'm still on the page that the FOMC is going to have to go back to the zero line. They will have no choice. Anyways, there we are. We're going to get our 25 on Wednesday. And probably a signal that there's still another rate cut. We don't get a summary of economic projections with this one. Trump is potentially meeting with Xi at APEC this week. They're in Malaysia this weekend with the underlings of each one meeting on the sidelines to see if the two big guys can be seen together in the same place at the same time, talking about the same thing. And if they do meet, it's October 30th, I guess, is the tentative time in the AM. This is Thursday morning after the Fed, where Trump will announce that he won every swing state and that the election was rigged and that the war in Ukraine never would have happened if he were president, and no one's ever seen anything like this. He might talk about trade with China. Reserve, the reverse repos, look at this, 2.4 billion is the lowest of this cycle, the lowest. It hasn't hit the zero line yet, but it is threatening the zero line. Reserves under 3 trillion still, and you still have little bits, I wouldn't call it stress, but little bits of angst showing up in the repo market, that some banks feel the need to use the Fed repo window or risk paying over 4.25% to borrow. That is a little bit of stress. And the reverse repo, this is a measure of excess liquidity. So this excess liquidity is almost gone. So you could say, well, there's basically no excess liquidity. Now we're just on, well, I guess you'd call it standard liquidity. TGA, 905 billion. Now, what's sitting in the TGA is not a reserve. Since the shutdown, the TGA has gone straight up, being that there's only so much in funds that are floating around out there. What lands in the TGA account is kind of like a leak in the bucket, because it can't be paid to people who might otherwise put it in the bank, which otherwise might be reserves. So if this were more around the 750, which they were targeting, instead of the 905, reserves might be $150 billion higher. So the shutdown could be, although I'd have to think it through a little bit more. I just thought about it now as I saw it. Shutdown could be taking reserves out of the system because the Treasury is just not paying anyone. Right after the meeting, we've got mouths flapping right away. Logan and Bowman on Thursday, Logan, Bostic, and Hammock on Friday, and then next week, ooh boy, I'm sure there's going to be a lot of talk. The capital market to money market curve still upward sloping, hasn't inverted again yet. 9 basis points, still sitting mid-50s on the 2 to the 10-year. I heard someone suggest that could be 150 basis points by the end of next year. 150 would be 100 points lower on the 3-month. Well, 100 points lower is basically what ZQ is pricing in over here, and suggesting that the 10-year will not move, that the 10-year will anchor to 4% while the 3-month rate will go down. I have a hard time seeing how that is going to happen, especially now with France. I think when people watch this, and all the important people who are well placed to watch this are going to go to their managing directors and say, you know, this guy pointed out something, that we're accepting 56 basis points less on French debt than we would be on U.S. debt. We could improve our return by simply selling French 10-year bonds and buying U.S. 10-year bonds, where we don't have to worry about elections in the U.S. anymore because there won't be any. Why don't we do that? Maybe that'll happen. TLT still squeaked out a good week. Well, yeah, good week. 0.27, but still, I'll take anything positive on TLT. After waiting this long to finally be treated somewhat right, I'm happy about that. SPX 1.92 because, of course, rate cuts. But don't tell ZQ that. The dollar index up 0.46. Gold and silver. Oof. Turn your head. If you have young ones in the room, block their ears. Gold down 3.5%. Silver 6.6%. This kind of volatility, we're in meme stock territory with gold and silver. And finally, ZQ, effective federal funds rate, still sitting at 4.11. I check that every day to see if that was moving. I think this is released. At 9 a.m. every day, and reverse repo I think is released at 8:15 every day, or it could be the opposite. I'm not sure. There's the 2 rate cuts this year. I think even ZQ is in wide agreement with that. The January 2026 ZQ sitting at 96.40, implying 2 moves from where the effective federal funds rate is right now, implying 2 moves. So there we go. 1 cut in Q1, and then this is just completely wrong because you're going to be dealing with an ex-Powell Fed, and we haven't had the announcement yet. It is late fall. We haven't had the announcement yet of who the new chair is going to be. I think we'll probably see that in the next little while. I think we're waiting till after November 5th to get that. November 5th is the Supreme Court hearing of the legality of the Trump tariffs. Don't expect a decision. They'll hear arguments and then they'll go away. I don't expect any decision. But based on how those arguments go, Trump will decide whether he can use Waller, which Wall Street would accept, or if he'll elevate Stephen Mirren to head of the Fed to get his 500 basis point 600, 700 basis points of reduction because he doesn't know math, so why not 700? So I think that that is wrong. Even with a Waller Fed, I think that is wrong. 4.5 cuts in 8 meetings. I've got the M over here where the meetings happen. Powell is done here. These are without Powell. These are ex-Powell. We know we're going to get 2 of the 4, so we're looking at 2.5 from this point forward. 6 meetings, 2.5. I don't see it. Real rates all negative, and because we had such a low read on inflation month over month, the market expects, oh my God, it's going to go higher, even though it's been coming down. So I don't think the markets are talking to each other anymore. I think you just have a bunch of silos. The bond people are saying, can you believe those stock people? And the stock people are saying, can you believe those bond people? You just can't have a conversation with them. Thanksgiving is going to be awkward. You a bond person or a stock person, right? That uncle that comes over who talks about bonds, you're never going to be able to have him over. OAS all contracted. And look at this mortgage rate, 6.19 for those watching the housing market. 6.19%. We had one home builder report this week, Pulte Homes, not very good. We're 20 basis points away from printing a 5 handle. 1 week change down 8 basis points. So the mortgage market is thinking, yeah, the 10-year is going to come down. And the bond market is saying, no, the 10-year is going to go up. The US 10-year is riskier than the French 10-year. What are you doing, housing market? Let's look at CPI. CPI came in lighter than expected. Let's just look at goods and services down here. Goods year over year 1.5%. Right, problem solved. The idea that we were going to see tariff inflation here. Let's just go to May. 0, 0.2, 0.2, 0.3, 0.2. That's no big deal. That's it. That's all you got. After all those tariffs, that's all you got. And services, 3.5% year over year. But have a look at the progression here. 0.3, 0.2, 0.3, 0.4, 0.3, 0.2, all the way. 2, 3, 4, 3, 2. It's coming down. Where are the big numbers here? Look at this year over year. This is medical care services, 3.9. This is immune from any interest rate. No matter where you set the interest rate, your heart attack is going to happen. Well, I shouldn't say that. The higher the interest rate, maybe the higher the probability of a heart attack. Somebody should do a regression on that. But medical conditions are going to happen no matter what's going on in the economy. So I do think that any measure of inflation should be adjusted to remove all of the things that the interest rate simply will not affect. Can't affect this. Shelter, year over year, is 3.6%. Higher rates only make that linger. The higher rates are, the fewer construction loans you're going to have, the fewer houses you're going to be building on spec. The home builders aren't doing that anymore. So the higher the rates are, the longer it will linger because you are actually constricting supply. PCE is the preferred measure. You're not going to get PCE. This is CPI. PCE always comes in lighter. The shelter component in PCE is half the weight of what it is in CPI. Some of the other ones are fairly elevated up here. If we look at food and energy, food 3.1% year over year. And energy, 2.8%. Have a look in this column here. Energy, month over month, 1.5. Energy commodities, 3.8. Gasoline, all types, 4.1%. Energy services have come down a lot. But look at this, the 11.7 year over year. This is utility services. You sort of want to be in utilities, right? headline, if you bring out the decimal places, because still only one decimal place. If you look at other countries, you get multiple decimal places. There is information in that decimal place, because this 0.3, if it was 0.251, they just say, oh, that is a 0.3. But that's a big difference, because if it were 0.249, it would be 0.2. Right? So there is information there. Headline 0.31 month over month instead of 0.3. So, okay, not a lot of information in the next decimal place. 3.01 year over year. Core 0.227 and 3.02 year over year. Super core 0.4 year over year, 2.57. And this the super core. These are imputed prices. So it appears that the imputation looks like it's biased to the upside. So that if you could have carried out the actual data collection, I am pretty sure it would have come in lower than expected, not higher lower, even lower, not lower than expected. It came in lower, even lower than this right here. And I do believe we have a background of deflation in the economy, and I think the Fed would be well advised to not just be data dependent, but data expectant, to suggest that this new operating system we have out there based on LLMs, AI, is not taking jobs is a ridiculous thing to say. You have, I think, a ban from any government employee anywhere saying that AI is taking jobs. They do wrap themselves in pretzels to say that AI is not taking any jobs, that it's going to be a job creator. And they promote all these stories about companies are not finding any benefit from AI. I use AI. And let me tell you, there's an absolute benefit. I cannot be the only one. I cannot be that unique that I'm the only one. Although I have heard that many times in my life when I return something because it's broken. Really? You're the only one. You call customer service because something's not working. Really? You're the only one. I don't know how many times I've heard that I'm the only one. Maybe I am the only one that's actually getting benefit out of AI, but I can't, it just doesn't seem to make any sense to me. I know other people who use it, who have jobs, who say, yeah, their output is way up. They don't need to hire people. You can even get rid of people. To say that it's having no effect, I think, is whistling past the graveyard. So if the Fed is relying on government employees to say, oh no, this is actually going to create so many jobs, you're going to get a productivity boom. No technology has resulted in a productivity boom that has increased GDP. It has resulted in productivity booms that have creatively destroyed other industries. This is a general purpose technology that doesn't need a human anymore. That's the big difference between this one and the others, is that you're not adding capital to humans, you're removing humans with capital. You're avoiding having to hire any going forward. I don't know if it's eating away at too many jobs just yet, but you're certainly avoiding jobs. They're gonna have to pay attention to that. And if you do have this big boost in productivity, you're going to have this big increase in supply, which is going to put downward pressure on prices. Let's not forget about China. So you have the US, which has set up a big wall around itself so that nothing from China can penetrate this wall. But it's going to go to other places. It'll go to South America, it'll go to Latin America, it'll go to Africa, it'll go to all the other places that allow the Chinese goods in, because they have no production capacity. And why not have cheap product? Which means all the American goods that went into those places will no longer be needed because Chinese goods are going to those places. China's running on massive manufacturing overcapacity. And that is going to be deflationary everywhere. And even though the U.S. protects itself from that stuff coming in, they're going to end up with a surplus of their product because other countries will gladly say, we'll take the Chinese product. We'll take everybody who buys a Chinese EV is not buying an American car. I think we can say that plain and simple. They're not buying a European car. They're not buying a Japanese car, a Korean car, an American car, because they're only buying one car. So the Fed, I think, has to start to be forward-looking. I don't see a choice, given the level of debt, given the unwillingness of the elected officials to address the level of debt, and they won't, because elected officials do one of two things. They do the selfish thing, or they do the popular thing, but they do not do the right thing. The right thing would be to cut government spending by $2 trillion, which means eating into entitlements. You're not getting elected. That's not popular, so you're not getting elected. So they'll do the selfish thing or the popular thing, but they won't do the right thing. The adults in the room must be the Treasury and the Fed. And if you have a spending problem and you refuse to fix your spending problem, the only thing we can do for survival is make your spending free. 0%. I think it is an inevitability, whether they want to or not. Well, they probably would significantly disagree with me, but they will be forced into the situation where they will have no choice but to go to the zero line, because you can't count on your politicians to fix this, so forget about that. You do have a debt problem that's only going to get worse. $2 trillion a year added to the debt, $1 trillion of that interest only. You can fix that. And a looming employment crisis. And you haven't even seen the full effects of tariffs yet on manufacturing employment. I don't know that, other than announcements to please the Mad King, I don't know that any company really is going to put in $5 billion, $10 billion, $15, $20 billion on a regime that might disappear in 3.5 years and all these tariffs go away. Or that the Supreme Court, when they decide, agree that, yeah, these tariffs are illegal and it goes away. I certainly would be committing those kind of funds that early in the system. Okay, this week we had GM and Tesla. With GM doing extremely well, hitting $70 now. When they reported, they were at 50, I think 56, 57, somewhere in around there, and end of the week just touching 70. Nice all-time high for GM. I expect that to continue on. And we had Tesla. I listened to the conference call and I thought, why is anybody buying this? $1.44 trillion company. And you have a CEO that is, I think, barely comprehensible with, I think, no idea of when things are actually going to get done. At least that's the takeaway that I had. Let's have a look at its income statement. Revenues, 3 months ended September 30th. You went from 18.8 billion last year for the 3 months to 20.38% growth. Far cry from that I thought was 40% growth to the end of the decade. I was being told 2-3 years ago when I said that it's not going to happen. I was told that, oh, Boomer doesn't get it. 8%. But let's ignore the 3 months. Let's go to the 9 months. Last year, 53.8 after 9 months. This year, 49 billion. Even with this quarter, 53 billion to 49 billion. Down $4 billion, $4.8 billion. That's 10% down for the first 9 months. This is a shrinking car company. And the automotive regulatory credits are going down with it. 739 million last year, 417 this year. We can say that will probably disappear. So total automotive revenues, 20 billion to 21.2 billion, 1.2 billion higher for the 3 months. Not really that great. 57.2 down to 51.8. That is $5.4 billion lower, 10% lower on automotive. Energy storage, a little bit of a bright spot here, 7 billion to 9 billion over the first 9 months. But If GM's a $65 billion company with sales way above where Tesla is, more profitable per vehicle, even with the tariffs, and cash flow that would embarrass Tesla, if that's 65 billion for a growing car company with its EV is growing at double-digit growth, double-digit, not shrinking but growing, then let's say that Tesla is 65 billion too. I think it's probably a $40 billion company, but let's say it's 65. You got a $1.44 trillion company. We got to come up with 1.38 trillion somewhere. Energy is not a $1 trillion business. Let's be really aggressive for 9 billion in sales here. Let's give it a run rate of 12 billion a year, and let's give it a 10 times sales multiple. Even though it's only got 33-point margins, give it a 10 times multiple. Let's just be ridiculous. There's 120 billion. We've still got to come up with 1.26 trillion somewhere. You have Optimus. Come on. That is going to be nowhere near production. And the projections that I've been reading are that you're not really going to have a commercializable, across the chasm commercializable system till about 2050. You're talking a good 20 years away. So many problems still need to be solved. But Musk said that his are unrecognizable from humans. You actually have to poke them to see if they're real or not. Come on, man. I mean, we've seen these things. Come on, man. Anyways, you're going to give that a $1.26 trillion valuation. It is not the most advanced humanoid robot out there, and no other company, even with the more advanced product, equals that. In fact, you could take all the robotics companies, all the humanoid robotics companies, stack them together, and together they don't equal 1.26 trillion. So give that another 100 billion. Let's be really crazy and give it another $100 billion. You still got to come up with some 1.15 to 1.2 trillion dollars. I do think that is just fluff. The cult, it's all cult valuation. So if I had to figure out what price it would be, multiply the current price by 0.2, what are we, 420 bucks? $84 probably be the right price, 20% of what it is right now. Let's look at their gross profit, $5 billion on $20.5 billion in automotive sales. Well, let's look at their total revenues, $28 billion, $5 billion. Last year was only $25 billion. This year was $3 billion higher. Last year, $5 billion. So the extra $3 billion amounted to nothing more. For the first 9 months ended, 13.2 billion last year, 12 billion this year, $1.2 billion lower. And if we come down to our net income, 1.389 in net income last year was 2.189 for the same 5 billion. You started a gross profit of 5 billion, kept 2.189, had 5 billion, only kept 1.389. I'm seeing the R&D, significant investment in R&D and higher SG&A prices. I don't know that this R&D is getting very far. Last year, look at this, first 9 months, 5 billion, first 9 months, 3 billion. Now, if I didn't tell you who this was and I just put these numbers up on the screen, I would say, what do you think of this company? You'd probably say there's some very significant problems in here. Right? Let me show you something I've been working on. Let me bring it over to the screen here. Whoops, where are we? Oh, I lost it. There it is. So I've been working on, I've been looking at Ouster, which is a LiDAR company. And to understand Ouster, I had to do some diving on the LiDAR industry itself. So I thought, well, let's do a quick primer for LiDAR. And what I thought I would do is do a case study in here and compare LiDAR versus vision only. The Waymo approach is a multi-sensor approach. It has 5 LiDAR sensors, 29 cameras, 6 radar units. Whereas Tesla uses camera only. So I do a little bit of analysis, technical trade-offs, cost structure implications, safety and regulatory. I can't take credit for this one. I set up the scenario with Google's DeepThink, and I said, here's some information on Waymo's setup. Here's some information on Tesla's setup. Use your internet search tools to educate yourself on both the fusion system and camera only, and give me your best approximation as to what you think between the two. Give me a small little analysis between them. So this is a DeepThink that gave me this output here. The most likely response is that right here, current market trends suggest a middle path. Most global OEMs, excluding Tesla, are adopting LiDAR for level 3 systems. Over 100 design wins, 22 automotive manufacturers reported by Hesse. This is a Chinese supplier. They supply like a third of all LiDAR systems. Waymo, by the way, this was surprising when I did this. Waymo is level 4. Within its geofenced area, it has achieved level 4, which means no driver and no safety driver in the front seat. You don't need anything in the front seat. Tesla is still at level 2 with their camera-only approach. These guys are at level 4. So I thought this will be up this week in, I believe it goes in the information technology sector. If you have the sector studies, it'll be in electrics and electronic equipment, but that'll be up this week. Let's turn our attention to SPY for a happy story here. All-time high 677.25. Triple Q's all-time high 617.10, and for want of 90 cents. IWM missed its all-time high, 250.33 on October 15th, still holds 249.43, hanging out there. IJR still nowhere near, still a good $5 below its all-time high. And volatility disappearing, 13-week implied volatility percentile, 55th percentile, down from the 97th percentile. IV last 12.8%. The forward 4-quarter operating earnings, 294, closing SPX 67.91, pushes you over the 23 times forward multiple, 23.04. Last week was 22.64. I should stress this is operating earnings, not EPS. EPS is further down the income statement. This is just operating earnings. If you were going to look at forward on as reported, which is EPS, you'd be somewhere around 27 to 28 times forward earnings. EPS, 27 to 28 times forward EPS. This is just operating earnings. And for earnings this week, this is a big week. You have every week is a big week. Every week I say the same thing. It's a big week. It's a big week. You have Bank of Canada and the Fed being the bigger show in town. Next morning you have maybe Trump and Xi, if Trump is done throwing his little tantrum about Ontario's ad with Reagan in it. If he's done throwing his little tantrum by then, we might have something Thursday morning, maybe. And you have earnings. Depending on which site you want to look at, you either have 172 companies reporting, or if you think that's a little light, head over to Sector Spider and they'll give you 176 companies reporting. Last week I was earnings week. I played 14 of them for earnings vol, which is just a fun thing to play. 12 of 14 paid nicely. I have a rule with earnings vol is if I don't want the underlying assigned to me, I don't do it. Even though I look at the setup and I go, it probably wouldn't be assigned. If it was, I would have a problem with it. I would say, well, I don't want this, which means that I'm only playing. That means I only have one play, which is earnings vol. I don't want that. I won't do it unless I do not mind owning the company. So now I have two plays. If earnings vol doesn't work out, well, probably would have bought it at this lower price anyway. So thank you very much. So 12 of 14 worked out, and 2 didn't. But the 2 that didn't, I don't care. I'm more than happy to have them at these lower prices. Let's have a look at who's reporting this week. And if you stick around to the very end, I'll tell you the big changes that are happening to the applied level, with one of them being somewhat related to earnings. Okay, we'll start with Monday here. We have 3 that are reporting before the opening bell: Electronic Arts, Keurig, Dr. Pepper, and Revity. I wasn't interested in any of them. There are some companies that I don't mind owning at certain prices. Those are ones that I'm interested in playing for earnings vol. And there are some companies that, even with earnings vol, don't present any very good setups at all. So it's one of those, I'd be interested in these, but I'll have to wait and see. And usually I don't decide till late in the afternoon. Early in the morning, I have an idea of what I'm looking at, but by 3:30 I can tell, okay, it's these ones here. I'll know based on the setup that it provides me. Some companies just don't provide you a very good setup, and you need options for this, and some companies just don't have liquid options, so there's really no point. So after the bell, we have quite a few. Arch Coal is something that I would look at. Nucor, NXP is something I would look at. When you get to the health companies, I don't understand health, so I just avoid it. When you get to the real estate companies, usually getting any kind of IV higher volatility before earnings is really tough to do. They usually have very, very little. They don't really provide very good setups at all. Going into Tuesday, for any setup you do on Monday, you do have to consider Tuesday before the bell. So you have to include all of these, from Zebra Technologies all the way up to Xylem. You have to decide whether you want to do any of these. DR Horton, given Pulte Homes last week, I'm not sure that I would be too eager on DR Horton, but it should offer wider wings. So there are a number here. Corning is an interesting one. Nextera, PayPal. I don't know that I would be too interested in PayPal. And then what do we have at night? Any really good ones? UPS. That's an interesting one. Sherwin-Williams is another interesting one. Booking. We'll see what kind of setup that provides. Boston Properties. I like Boston Properties. One Oak. I do have a position in Boston Properties. I do have a position in One Oak. You have Seagate and Teradyne. Teradyne within it has a robotics, a humanoid robotics division. Small, but it's there. It's inside. If you wanted to play on something, Teradyne is there. Visa and Mondelez. Next, a CAT is there's ADP. We have Boeing, Centene, Fiserv, Generac, Garmin, Kraft Heinz. Kraft Heinz hasn't been doing too well, but we'll see. None of the staples have really been doing too well. Old Dominion Freight, Otis Worldwide for your elevators. Who else have we got? Verizon. We've seen AT&T, we've seen T-Mobile, and now Verizon. T-Mobile took a bit of a dump on its earnings, but it seemed to be okay to me. So it might be an interesting play for selling some puts on. Avalon Bay. What else do we have? Chipotle in here. Equinix. That's a my brain. A REIT, digital data center REIT. Did I say that right? Data center REIT. Alphabet, there's Google. Meta in there as well. Microsoft, oh, that's going to be a big night. ServiceNow, that's a high flying stock as well. And Wednesday we don't have very much. I guess nobody really wants to schedule much on a Fed day. Starbucks, maybe companies that want to hide, right? If you want to hide behind all the other headlines, you put it on a day like this. Starbucks, Mid-America Apartment, eBay. You think any of these companies have a reason to want to hide? Next morning, anything exciting that I would follow? Like Biogen, Bristol Myers. I don't follow companies like that. I don't understand healthcare, and I don't have the science, and I don't want to learn it. Fox, Hershey, International Paper, Kimco Realty, Kimberly Clark, MasterCard, Merck, S&P Global. Looking for interesting stuff that I would follow. Amazon, Coinbase. I forgot that they're in the S&P 500 now. Apple is in there as well. Apple, Amazon, Coinbase. Big tech night there. Thursday, First Solar, Ingersoll Rand, Western Digital. Western Digital and Seagate just have been on just a tear. And on Friday, we don't have much. Usually this is all AM. It's all AM. Oh, PM is you are really trying to hide. And then you'll release your earnings Friday after the close so that nothing can happen. Lind in chemicals are the largest in the chemical space. AON, ExxonMobil, Colgate Palmolive, Chevron, Dominion Energy, Berkshire Hathaway. There's a interesting and popular one there. And that is our week in earnings. For those with the applied level, I do post in Dr. Mark feed, I do post at the beginning of the day what I'm looking at for earnings. Usually it's a short list of what's being reported that day. So if you have 20 companies, usually it comes down to about 5 or 6 for me. And then usually by the end of the day, it's a subset of those. There's 3 or 4, and then I usually post what strikes, what expiration dates, and what strikes I'm doing before the close. So if you have applied level, you can access my thoughts during the day. Okay, our spotlight this week is on Ouster, a LiDAR technology company. Huge IV, 129.3%. Paradoxically, these end up being safer companies to play. And you may wonder, how can IV of 130% be safer? From a risk management perspective, the options give you so much to work with that they are actually much safer than a utility, a very stable utility with no options. From a risk management perspective, these things are safer. Lots of volatility. Mid part of the range, somewhere around 32. It oscillates around down to 27.50 up to about 37.50, and this thing does move. It is a story stock because it doesn't have a lot to support it. It does lose money. It is a cash burn company with revenues. Run rate somewhere around 120, 130 million a year. Small, but is not profitable. They have earnings on November 4th. Before I continue on, last week I did Bloom Energy. Be aware that they have earnings October 28th. So if you are in BE at all, be aware. Tuesday, you do have event risk. They do have earnings on October 28th. But with their Brookfield deal being a subsequent event, subsequent to the quarter end, they are going to talk about it. Their guidance probably will carry the day. Earnings on November 4th. They are in digital LiDAR, solid state digital LiDAR, merged with Velodyne in 2023. Important to recognize here, LiDAR is still in the very early stages of adoption. It is also a very competitive market. What is, I guess, nice about Ouster is they are not a pure play on the automotive sector. They have 4 verticals: industrial, robotics, smart infrastructure, which I think is probably going to end up being a bigger market than most people think. And I think it's more important in that LiDAR in the infrastructure than in the vehicle. So I think that is a bigger space, and they do have automotive for advanced driver assist and autonomous vehicles. Industrials, things like warehouse automation, autonomous mobile robots and logistics for robotics, autonomous delivery, ag tech and construction, smart infrastructure, intelligent transportation systems, security, crowd analytics. They do sensors and software. Their software here is called Blue City. And here they have software for automotive as well, Gemini, perception software platform, 3D object detection, tracking and classification. The big problem in the automotive is that most of the majors have their own LiDAR divisions internally. It is, I think, a necessity for full self-driving is a combination of a LiDAR, camera, and radar. I think it is going to be a fusion of the three. It is not a matter of a single one winning the show. It's a matter of all three. And I think of full self-driving and autonomous vehicles sort of like I think about the blockchain. Great solution to a problem that not a lot of people have. For me to get in my vehicle and drive to the store, it's not a big deal. Drive to the mall. I just don't feel a pressing need to solve that problem. If I were spending an hour in traffic every day, then yeah, that does solve that particular problem. But there are many countries and many cities in this world where you're just not getting this done. I spend almost half my year now in San Jose, Costa Rica. You're not getting it done on those streets. You're not getting it done. So it is very few globally, if you think about it, very few markets really. I don't see it as that big a business as I guess some other people do. I think it's inevitable that you will have robo-taxis. I just don't see it as being a replacement for a significant amount of the fleet, maybe 5%. Smart infrastructure, I think, is the bigger play on this one. Q2 end, because we get Q3 on November 4th, so we just have Q2 end to go with. Sitting on cash of 229 million, 78.6 in cash, 150 in short-term investments. Say some 57, 55, 60 billion of that was raised with a share sale, so they are still issuing shares. No debt, equity based on paid-in capital and accumulated deficit. The net equity that's left is 221 million. Okay, let's look a little bit at their financial story. This is an unprofitable company. It is a cash burn company as well. Long-term goals, 30 to 50% annual revenue growth. Midpoint, 40%. We're going to use that. Gross margins, 35 to 40%. Midpoint is 37.5. We're going to use that. And number 3, capping OPEX at the Q3 23 level of 38.8 million. Call it 39 million to keep CapEx there while they pursue goals 1 and 2. Did not get that done in Q2 of 2025. So let's calculate what their operating break-even would be. If their operating expense is 38.8, their gross margin would have to be 38.8. And if their midpoint is 37.5, they'd have to have revenue of 103 million for the quarter, which is 3 times more than where we are now. So if we grow this at the midpoint of their growth at 40%, it would take 3 years for them to reach break even at 40, assuming that they can grow 40% year over year and keep 37.5 gross margins. They were 33.3 over here, and they haven't been very successful, at least so far, in keeping OPEX below that level, at least not for the 3 months ended in Q2. We get Q3 in not this week coming up, but next week. We'll see what we get. Their guidance was for 35 to 38 million in sales. The midpoint of this represents 4% growth for the quarter, or 16% for the year. That is a far cry from the 40% here. So this 3 years to break even assumes that they can hit their long-term goal targets every quarter from here on in. That's not going to happen. So long-term, let's take that to be in the 5 to 10 year range. So probably for the next 5 years at least, this company will not be profitable. However, they do have cash on hand, 229 million. Their first 6-month cash burn, at least from operations, 6.2 million. They did raise money from a share sale this year, issuance of common stock. They raised 59 million of cash this year through a share sale. And even though they have the cash, and they probably could make it through, I say probably could make it through because they have at this, if they can keep this at around 12 million to 15 million a year burn rate, you have over 10 years of cash available. But as you scale up, that cash is going to disappear a lot quicker. Share-based compensation is huge. First 6 months was 21 million. So if you look at their operating expense, roughly 80 million for the first 6 months, 21 million of that was share-based compensation. 27% of their operating expense is share-based compensation. So yes, there is going to be dilution. Looking at their operating expense as a percent of revenue, 127% last year for the end of Q2, 122% this year. So they have a long way to go. You got to get those revenues way up because I don't know that you're going to get these expenses down very much. However, the share-based compensation does show up in here. Even though it's added back in cash flow, it does show up in there. There's some debate about how you should handle that. It's added back in the cash flow from operations to show cash flow, but it is a real expense because if you didn't have share-based compensation, you wouldn't be able to get the people that you have. You're paying them less and giving them share-based compensation to attract them, to save on cash today. But if you didn't issue shares, you would have to pay them those market rates. So I do see it as a real live expense, even though it may not be an immediate cash use. It is a live expense that has to be accounted for. It is accounted for appropriately. Okay, and let's finish up with the primer here, the LiDAR primer. I wanted to do Ouster this week, but I really had to learn a lot more about LiDAR. And as I was doing it, I thought, well, let's make my notes. Let's write something up. At the very end of this document, there is, it goes through publicly traded companies, Luminar, Ouster, Innoviz. So there's a bunch in here. Automotive OEMs with LiDAR integration, General Motors, the Chinese EV manufacturers, European luxury manufacturers, their component suppliers as well. Investment considerations. There's a number of considerations, key risks and challenges here, and critical metrics to monitor: design wins, unit shipment volumes, average selling prices, gross margins. So what I did was I applied that all to Ouster. This is an October 2025 analysis, meaning I did it in October of 2025. But these points here, let's see how they do on those. So design win announcements, strong traction, secured multi-million-dollar agreement with Komatsu to supply LiDAR sensors for autonomous mining equipment, significant design win in the industrial automation sector, selected as the exclusive provider of long-range LiDAR sensors for Motional's Ionic 5 based robotaxis through 2026. So there's a bunch here. Pipeline development, Blue City Partnership Network now spans 39 states, with Ouster signing 3 exclusive partnerships for major markets, including Texas, Michigan, New York, and Pennsylvania. And then I give an assessment of it. Unit shipment volumes. Ouster shipped a record 5,500 sensors in Q2 of 2025, 33% year-over-year increase. The company experienced a 1,000 unit increase in shipments between Q1 and Q2, demonstrating accelerating volume momentum. An assessment here: average selling price. This is sort of dipping a bit, but not much. You're going from 6,400. This is a 63, 69, 36, slight, but you could call it a rounding error. Gross margins. Talk about gross margins, and assessment on that. Cash burn rate and runway. Strong balance sheet position. They do have operating losses, and I don't see this ending in the next 5 years unless growth really accelerates and they go higher than the top line of the 30 to 50% growth that they're looking for. Regulatory developments. Favorable regulatory tailwinds. Most significant regulatory development is Ouster's Blue UAS certification, making the OS1 the first 3D LiDAR sensor approved by the U.S. Department of Defense for unarmed aerial systems. Infrastructure spending, autonomous vehicle milestones, kind of mixed in here. Infrastructure contract awards, growing smart infrastructure revenue. I think this is understated. The size of this market, I believe, is understated. To get true autonomous driving, it's not enough to equip the vehicle. The infrastructure has to be equipped. And this way here, you'll have much better communication with all the vehicles, not just one trying to figure it all out. I think this is sort of underestimated here. Technology benchmarks, competitive positioning. So I did one on each one. I give an investment thesis, I give the bull case, and I give the bear case for it as well, and I give a verdict for it. So this is it's a short document. It's only 20 pages. It'll help you understand the LiDAR industry. I do the camera only versus fusion technology, Waymo versus Tesla analysis. I shouldn't say I asked DeepThink to give me that, because that is where DeepThink does really well in complex situations like that, where it can do a bunch of trade-offs very quickly, and think of a bunch of different options that maybe a human doesn't always consider. And then finally, at the very end, I do a more detailed analysis of Ouster on the points that you should look at, because this is a pre-profit company, and it's going to be pre-profit for the next 4 or 5 years. So measuring it on financial metrics doesn't make a lot of sense. You got to measure it on other things, so that'll help you out. This will be up this week in sector studies. Information technology in the sub-industry is electronics and electric equipment. Okay, let me tell you about some of the changes that are coming to the applied level. The applied level has two verticals, one that is focused on analysis and one that is focused on asset management. And it really has two target markets. There is the CFA market, CFA candidates, CFA charter holders, and the retail market. This surprised me when I heard this stat. The retail side is larger than the active side based on assets under management. So when we look at the marketplace and all of the assets, there's the institutional side and then there's the retail side. Retail is someone like me. I'm managing my own portfolio. I make my own trades. I don't pay anybody any fees for that, for at least the sliver that I operate myself. So I would be considered retail. Institutional breaks down into passive and active. Passive being the biggest part of the market now. The biggest part is active. Usually it is either active or passive followed by retail. Retail is small. Now the biggest part is passive followed by retail followed by active. Retail is now bigger than active. You can't ignore a market that's that big. So each of these two verticals are targeted towards retail as well. For the CFA space, if you are a CFA candidate, I really do think at level 1, level 2, you should have the CFA Plus subscription, which gives you access to applied analysis. And there is no expiration on applied analysis. You only pay for a subscription once. It doesn't expire. In here we have sector studies and all the sub-industries. There's 163 sub-industries, and I am producing a PDF for as many of them as I possibly can. CFA style, meaning that if you're used to the readings in CFA, the writing style, it is along the same styles. And every sub-industry PDF has one section for financial modeling, which would describe how you would start thinking about modeling revenues, how you would model expenses, how you would model different line items that you would typically find in that particular sub-industry. And here there's a focus is going to be on certification, sector specialist designations, the first one being energy. All the PDFs for energy are done. I think only 2 more have to be uploaded. That is carbon capture, utilization and sequestration, and small nuclear reactors. And that rounds out the energy PDFs. The QBank is also available, and it is, again, CFA style types of questions where you have a question set up with ABC. A lot of the most likely, least likely types of question setups as well. 2,600 questions so far. It's going to get significantly bigger than that. Most of the focus has been on filling out the energy sector, the sub-industry. Actually, it's the entire sector, all the sub-industries, because it is the most cohesive sector out there. Some sectors have different industry groups that are really far apart, that really require their own specialist designation. After we're done this, I'm going to go to mining. Now, mining is not a sector. Mining is an industry group within the materials sector. So it'll be a more specific designation. But the CFA group, because they're getting ready for a career, the big concern here is certification. Can you certify to my employer that I know certain material? Is there something you can do to certify? That usually comes with some kind of work that you have to do for the financial modeling certificate that we do using Costco. We do give you a certificate, but you must do the financial model yourself and submit it. For these ones, for the sector specialists, there would be an exam. First one will be energy. I'll have more to say about that in Q1 of 26 of exactly how that's going to work. But if you are entering the CFA space, it is getting more and more competitive. More and more now, you need to be an expert in what you do. I don't know if you've seen this. I'll just drag that onto the screen. OpenAI hired 100 ex-bankers from JP Morgan, Goldman Sachs, Morgan Stanley to train these new models. Reportedly launched a secretive project named Code Mercury. Guys, it can't be that secret if it's in every headline and you actually have a name for it, right? To train artificial intelligence to build complex financial models. I said this 7 months ago, that the skill you're learning with Excel, I think, will be a useless skill in a couple of years. The financial modeling part will survive, which is the CFA part. How do I model this line item? How would I think about the relationship between these balance sheet accounts and this income statement account? So I do think we need to downplay the financial modeling skill set of it and focus more on the CFA skill set of it. And because of this, these are entry-level jobs. They're disappearing. It becomes more important that you become an expert sooner. And that is what the sector studies are meant to do. For the retail side, there still has to be analysis, but this is, I think, a lot of these PDFs are going to be a lot of overkill for the retail side, because you're not going to the institutional side. So there's a lot of stuff you just don't need to know. If you're a retail investor, retail trader, you don't need the 3 letters. You don't need CFA behind your name, but you do need a large subset of the knowledge that they have. Same within the PDFs. There's a lot of it that's overkill for the retail side, but you do need some of it. So I think it would be a little unfair to say, well, you should read these PDFs, because a lot of it may not be of any interest to you. So for here we have the infographics. The infographics are basically a prompt library, and it gives you prompts. And I follow a 10, 20, 30, 40 system. So 10 prompts at the sector level, 20 at the industry group or industry level, 30 at the sub-industry level, and 40 at the company level. So if you want to get to know a company from a top-down perspective, you have 100 points. Within these 100 points, you should have a fair idea of what this company's offering you, and really understand the industry and the sub-industry that it operates in. Now, as you go through them, you might say, well, I know most of this stuff, but there's about 15 that I don't understand. Because they're prompts, they allow you to build your own reading. Let me show you how this works. Let's first of all bring this onto the screen. There is our infographics. So we'll click on this one. I've already got one set up, so we'll follow the trail here. We'll go to information technology. AMD has been a sort of a stock on the run lately. So let's say that you're thinking, well, I'm going to take a position in AMD. You should at least know the industry, the sector that it operates in. So here's information technology. These are all prompts, by the way. Here are 10 prompts for the sector itself. Then we'll select an industry group, which will be semiconductors and semiconductor equipment. And we have a bunch of prompts here as well. And you can just scroll down. All of them are prompts. Each one, inventory levels, gross margins. You want to know more about gross margins. The distinction between leading edge and mature nodes is vital if you want to know the difference between these. Keep in mind we're talking about semiconductor and semiconductor equipment, right? So understanding node size is critical in this industry. Select an industry, and from that we will select a sub-industry, which is semiconductors, and this gives you 30 points about semiconductors. Disaggregated value chain. Industry is segmented into distinct business models, integrated device manufacturers that design and produce their own chips, fabless companies. You may say, well, I want to know more about that. I'll show you how we can use this. Just remember this. The industry is segmented. This whole thing is a prompt, and I'm going to show you how to use the prompt. And then once you go through the sub-industry and you understand this sub-industry, you can pick a particular company, and let's pick AMD. And I give you 40 points that you need to know about AMD. Point number 6, gaming is a high-profile, lumpy business. Well, what does that mean? Let me show you what you can do after, and we're going to use just ChatGPT. Here we are. So notice what I've done here. Here's the quote. Everything within the quote, that's exactly the prompt that was written on the screen. And I just start with respect to the industry group, semiconductors and semiconductor equipment, tell me more about this. And here you go. This is where we're talking about the industry is notoriously cyclical, driven by supply-demand imbalances, periods of high demand, tight supply. And you get a small little document, there are 10 points here, which will tell you more about that one point. And you say, okay, that's good. You go down to the sub-industry and you say, well, there's something there I didn't understand, this whole disaggregated value chain business. Tell me, with respect to the sub-industry, tell me more about this disaggregated value chain. The core split and why it happened. Here are your IDMs, your fabless companies. This is where AMD and NVIDIA would play. Foundries, Intel has one of these. Taiwan Semiconductor, the big one. The assembly and testing, advanced packaging, EDA and IP licensors, how money moves through the chain. And there you go. So it gives you a nice little description and more detail about that particular prompt. And then for the company, here is the quote. Again, the prompt, gaming, with respect to company AMD, the company AMD, tell me more about this. And here you go. What's inside gaming, why it's lumpy. It gives you all of the, if you want to go right to AMD's results or their 10K and read a little bit more, it will. So it pulls it right from there. Visibility versus margins, seasonality and cadence to watch, next-gen timing, why the market's always looking ahead, modeling pointers, if you want to model it. And how you would get that done. So what you can do out of these 100 points is you can then build just the research document you want. As you go through all of the points, you could say, I know this, and I don't know this one. Hey, chat, give me more about this. Move on to the next. And you just cut and paste all of these in a Word, and in the end, you'll have a 15 or 20 page Word document that will give you just the research you need to know, because the PDFs that I do are going to be geared more towards the CFA crowd, and for the retail crowd, it's overkill. However, you cannot not do analysis. If you're not analyzing anything, you're really just gambling. And if that's what you're doing, then at least just admit it to yourself that you're gambling. So you have a prompt library. You build your own report. This is called just-in-time learning or point-in-time learning. The typical learning model, which we do up here, is we say, here is an inventory of knowledge. And I'm going to certify that you know that inventory of knowledge. And head out in the real world, and you'll find situations in which you can use this inventory of knowledge that you have. So it is not just in time, it's all right now. Here's all the knowledge that you're going to need, and off you go. The point-in-time learning or just-in-time learning doesn't focus on building an inventory of knowledge. It focuses on your path through the world and says, you need some knowledge right here. You need some knowledge right here. You need some knowledge right here. Point-in-time learning. That's what this thing does. There is no point in you learning anything about AMD if you say, I don't plan on ever investing in AMD. It's not my thing. I invest in energy companies and mining companies. Well, then why sit through an entire course that's going to teach you everything and build an inventory of knowledge when all you need is certain points of knowledge? So it is just in time or point in time. That is analysis. Let's move over to asset management. In the CFA side, we really prepare you for an institutional role, which I feel is not really a holistic approach to asset management, because it does not prepare you for an entrepreneurial role in the finance industry, which is your own hedge fund. That is the ultimate in the entrepreneurial role. It does prepare you more for the institutional side. So the asset management, the applied asset management that I do is CFA applied, leans more towards how a hedge fund would approach these things. So we look at risk management, heavily on risk management. And then all of the things that you cover in CFA, you come across carry trades. I'll show you how to do a carry trade. We actually do one in portfolio construction and management with the yen to the US. Curve trades in level 3. You do a lot of curve trades on the yield curve. Well, anything that has a curve, any futures curve has a curve trade. The setup is exactly the same. The reason for the shapes of the curves all differ, but the setup for a curve trade is the same, and so on. All the different things that you've seen. Market neutral setups, we do some of that as well. Factor portfolios, I show how you could set up a factor portfolio. And it's a focus on applied options and portfolio construction and management, because for risk management, that's where you are. I'm not a big fan of the word asset management, because I don't like it when we think about the portfolios in terms of we have a portfolio of assets, because then we focus on return. Return will be what return will be. You cannot control where the market will end at the end of the year or where any stock price will go to. You cannot control that. You can control your reaction to it, but you cannot control it. The thing we can control is risk. So if we're doing our job, a lot of our risk management came before any single name ever hits our portfolio. We've gone through a bunch of risk management first. Big part of that risk management is, what the hell are we doing? What are we looking at? That is analysis. We've done a lot of our risk management up front. Once it enters the portfolio, what we've done is we've introduced risk into our portfolio, because we could have sat in cash. That's risk-free. We can get the risk-free return. We think we can do better than the risk-free return by saying, look, I'm going to add this stock. That is not an asset. That is a risk profile. We've taken on a certain amount of risk. We need to be a risk manager, not an asset manager. And as soon as you start shifting your thinking from asset management to risk management, you'll see your performance improve significantly. For the asset management side, I'm also developing trading manuals. I've started in the derivatives section because we can get exposure to a lot of things with derivatives, and all of what's in applied options and portfolio construction will find its way into trading manuals as well. In derivatives, I've got energy derivatives, metals derivatives, grains, and livestock. And energy, we look at oil, CL. We look at natural gas, NG. We look at heating oil, HO. And we look at gasoline, RB. and also play some of the spreads, the crack spread. I show you how to set up a crack spread trade, a crush trade between corn and gasoline. And all the different trades, especially in metals, there's quite a few different curve trades and different relationships between metals. It's like copper, difference, the trade between copper and aluminum, platinum and palladium, the substitution effect in there. Gold and silver, the ratio trade in there as well. And I'll continue to add to this. I think I'm going to add the cash crops as well. That would be sugar, cotton, coke, coffee, things like that. Not that the retail can't benefit from this, but this is written specifically for a CFA audience. And sometimes it can be a little bit of overkill for the retail side. For the retail side, we're going to focus on some other things because these are typically capital constrained accounts. They're usually small accounts. They don't have the 50 million, 100 million, 200 million that institutional accounts would have. So some of the examples for the institutional side don't make sense in a retail portfolio. Some of these spreads you're not going to play in a retail portfolio. You're not playing a crack spread in a retail portfolio. Here, the bigger returns tend to be with volatility and momentum. So we're going to focus on that. And for the retail side, live sessions are probably more effective for the just-in-time and the point-in-time learning than all of these trading manuals are. And again, not to say that you won't get value out of the trading manuals, but the retail needs so much more. So we're going to focus on live sessions. And if you're in the market, you are in the market. There is no part-time game here. This is a serious business with serious money. It's not a casino and it's not a game. And if you treat it like a casino, it will treat you like a casino player. And most of them lose. The stats on retail investing, by the way, is that about 95% of all accounts end up going to zero. They end up blowing up. 95%. And that's because you are thinking in terms of return as opposed in terms of risk. Live sessions every Sunday night at 6:30. We're going to do the Globex Open and a pre-week. This is 30 to 45 minutes. That's all we need. Is 30 to 45 minutes to think about what do we see, what's the risk event, what are we worried about, what are we going to be focusing on this week, how should we be thinking about things. And then Monday to Friday, 8:15 to 8:45, we do a pre-market. 15-20 minutes of thinking about what are we doing today, what are we looking at, what names are interesting, what are we doing in the earnings sector, is there anything interesting to play, are we in trouble anywhere, how do we get out of trouble, how do we minimize any negative reaction that we've had. If it's red in the morning, we follow a general rule: you never sell on red days. You buy on red days. You never sell on red days. That's a rookie move. And you'll hear me repeat it again and again and again. This is all Q1 26 where this will really start. I am starting these live sessions tonight. I will start these. And then as far as the Monday to Friday, I'm going to taper into it. I'm going to start with Tuesday this week for probably the next 2 weeks. Then I'll go Tuesday, Thursday, for another 2 weeks, and I'll slowly build such that we are at 5 days a week. And we'll do our screen run-throughs. This is where we look for trouble, because trouble tends to show up in pricing and in spreads. So if we have our screen set up so we know what we're looking for, we run through them, we look for trouble. Is there trouble anywhere? No trouble, we're good. What's going on with earnings? What are we looking at for volatility plays? What are we looking at for momentum plays? What has hit our screeners? What's my, not just mine, but what are the planned actions for the week? And I'll lead off with you know, what am I doing today? Things like that. If you take a retail trader, most of them sit at home. They have nobody to turn to. They have no expertise beside them. They don't have the benefit of training below a seasoned trader who's done this for years and years that can slap them upside the head and say, don't you do that. What do you think you're doing? There are certain rules that you have to follow, and most retail traders do not follow these rules. When something is working against you, you need to move your delta towards zero. Most retail traders increase their delta. So they end up with big losses on names, 10, 20, 30% of their capital lost on any one single name. On any trading floor, you'd be fired if that happened. First of all, on any trading floor, you would never have been allowed to have a position that big because you have to have it approved by your managing director, and they never would have approved it. You have to walk in with your trade ticket. Here's my thesis, here's my security, here's my exit, here's my entry, here's my exit, here's what I'm going to do. Okay, off you go. And you can't deviate from that. If you deviate from it, you got to go in with another ticket. But retail traders get to do whatever the hell they want. That's the biggest problem. I've said this before, that you give me somebody for 6 months and I will change you. I will turn you into an income earning person. The goal here is month after month, your portfolio balance should be doing this. And if you can do that for 10 out of 12 months, that's pretty good. 12 out of 12 is superstar level. If you think about weeks, 52 weeks in a row, that's almost impossible to do because you are going to have down weeks. That's just the way it works. You're going to have down weeks. And if you go to daily, it's absolutely impossible, and you'll kill yourself trying to make sure that every day you're higher, because you're going to end up trading the noise. And you're going to be bumped around and pushed around by beta, because beta will push you around a lot. And you have to know when to just say, hands off the keyboards, boys. Shut the screens off, walk away. Hands off the keyboard. I do that quite often. Overall, for both the CFA market and the retail market, there's going to be less of a focus on video and more of a focus on live sessions. For the retail side, a lot of market sessions. For the CFA side, especially in the sub-industries, more classes. I'm going to schedule live classes so you can just attend live classes, which will be a mix of discussion and Q&A. And you'll know when the class is ahead of time, so you can read the reading or at least peruse the reading before the class, so you'll be able to keep up and understand and ask questions that, answer some real questions that you happen to have. Why the less focus on video? I am seeing this already myself. The ultimate learning style is a mosaic learning style. Mosaic means that I sit with you and I figure out where you are, and I teach you in the moment where you are, in the direction you need to go, with the depth and simplicity that you need at that moment. Hopefully to get you to the same end goal as everyone else, but with a different path. Brutally hard to do unless you're doing it one-on-one. For a one-to-many, it's impossible to do until now. LLMs allow this to be done. It's an operating system that removes the need for everyone to attend the same class in the same place and learn the same thing at the same time. That's linear learning. Video is linear. You press play, and here's the timeline, and it ends over here. And I'll say things here, and I'll say things here, and I'll say things here, but you don't know where I'm saying these things, so you have to go through it linearly. That's not very effective for learning. Whereas if you had a prompt window and you had your text up here, cut and paste, tell me more about this. Explain it to me like I'm in high school. It's not good enough. Explain it to me like I'm a 5-year-old. Explain it to me like I'm a 4-year-old. You can get it to keep telling it to you again, simpler and simpler and simpler each time. That is what is called a spider web form of learning, where the center of the spider web is where you are, and you decide which way you want to go. And as you start building out all of your branches, you'll find that the web connects after a while. That you end up building your own spider web, which from whatever center you start at. The more common expression is mosaic form of learning, or mosaic learning as opposed to linear learning. That's why I'm going to downplay the video. I think in a couple of years, video and linear learning will be just completely dead, and it will be more mosaic learning and bigger focus on live sessions. The financial modeling that is in analysis, the financial modeling and the AI for finance, I see no reason to continue to add to these, especially financial modeling. because the skill in using Excel to build a model will be obsolete in 6 months to a year. AI will be able to do this. There's already several AIs that are already building financial models. Manus can do it for you, and Claude with their skills. They have a skills module that can also do financial modeling. So it's just a matter of time before they all do. And these entry-level jobs begin to disappear, which means it is more and more critical you become an expert. And as a retail investor or trader, being that you are the second largest out there in terms of asset under management, you do really have to try to think as much as you can like you've had institutional training, even though you haven't. So let's get you that. AI for finance and financial modeling will be made free within the applied analysis. You will get it. Applied asset management, right now it's just sitting in applied analysis. We're going to move it over to applied asset management. If you're subscribing to the CFA level 1, level 2, or level 3 on our site, you will simply get these. They'll be just included for free. So they will be included. I was thinking of spinning them out all together for free, but I thought, it's for the retail investor. There is no reason why you would ever build a financial model. There is no reason why you would ever do it. It really only appeals to the CFA market. So it would just be wasted, I think, on YouTube. So we'll put it in, we'll just give it to everybody who subscribes, and everyone in level 1, level 2, level 3 will simply just get it. We use Costco to build a real financial model. And if you are on the CFA side, I strongly recommend the CFA Plus because you do get this analysis side and the possibility of building your expertise in these sectors. For the retail side, if you are characterized by making money, then losing money, then making money, then losing money, then making it, maybe blowing up a few times, it's not that you cannot be successful. It's just you have no process. With a process, you can be right 33% of the time and still do okay. If you have a process, if you have no process, you could be right 60% of the time and still lose money, because the 1 or 2 that you're wrong on, you end up blowing up on because you have no process. That I think you want to try to get as much as you can. I understand that sometimes the cost might make it inaccessible. If you are taking applied asset management, it is $425. If you are a markmeldrum.com subscriber, take $50 off. If you're in the CFA family anywhere, take $100 off. So that gets you to $275. And if you think, well, I still don't want to spend that, starting in Q1 2026, just this part here, just this little screen right here, which means no access up here. You don't need the trading manuals. Just for all the live sessions, we'll set something up at $25 a month. But you can see that if you did this for 11 months, there you are right there, and you'd get all of this. And there'd be no more payments. And this is $25 a month every month. You go 20 months, you've paid $500. And you'd still have to pay $275 to get this done. So, I will set something up for $25 a month if you want. But again, it seems to me that if you have all of the discounts, the $275 seems to be the way to go. Okay, that wraps us up for this week.